All right, welcome to the Mortgage Paid in Full program. So this week I'm actually behind on catching up on some of my videos. So I'm going to just share what I'm watching at the same time. It'll be a little bit longer because I think these two, one's 8 minutes and the other one's maybe 6 or 7. So about the same 15 minutes. I'm going to let this particular channel, MHFIN, do basically what my speaking for me. So the concept that I've been talking about for over the last year is that this was coming. Now the question is not that whether I was right or wrong, because I was right. Many people didn't listen when I was jumping up and down saying, hey, you need to take precautions, you get rid of debt, you need to take advantage of your idle equity to get your high interest rates that you're paying debt on down to very low. So all that stuff I've been saying, and now it's here. Mortgage rates have more than doubled in the first 6 months of this year, and all the other things we're seeing, from 8.5% inflation. Now we're seeing the Fed do one of the biggest rate hikes we've seen in a long time. The change in mortgage interest just jumped in the last week, the highest that it's done since I think it was 1987, just the highest in 1 week. So a lot of things are going on right now. A lot of people are saying this isn't just going to be inflation with a potential recession. They're screaming the other word of a 1929 version of a crash, similar to the 2008 Great Recession. That something big is getting ready to happen. You're seeing a lot of the NASDAQ major companies that are down 20, 30%. Apple, Amazon, Tesla, a bunch of these companies are taking huge hits to their actual portfolio. So a lot of the joyride that we've been on for the last year and a half since pandemic hit 2 years ago, there was a 30%, 35% market crash, and then it recovered. We've been in one of the greatest bull market runs in history. And now it's time to pay the piper for all the inflation. So I'm going to share my screen. You can check out these videos. I'll put them in the description if you're watching this by recording, watching it at a later time. So here we go. I'm going to share my screen, and there we go.
It's pure panic out there. Stocks are crashing, crypto is imploding, rates are skyrocketing, and your 401k balance is dropping like a rock. In today's video, we look into the latest data suggesting that this may possibly be the nightmare scenario we were all afraid of, a recession far worse than anything we have experienced in our lifetimes, more harmful than 2008, and possibly more destructive than the Great Depression of 1929. This is not clickbait, this is the truth. In today's video, we analyze the various market forces pushing the finance world to the brink. With all these signs of a recession, I've been thinking about wealth preservation and diversification. Franklin Templeton Investment Solutions states that the search for protection and inflation hedges is rapidly driving investor interest in real assets. Real assets are not only uncorrelated to equities and fixed income, they are also far less volatile, so investors have the opportunity to get strong returns without having to go further out on the risk curve. One of the most interesting real assets from a risk-return perspective is contemporary art. On the same day as the collapse of Lehman Brothers, a two-day auction in London racked in far more than had been anticipated, a development that led many to believe that the high-end art market is bulletproof even in times of global turmoil. This market has outpaced the S&P 500 by 164% over the last 25 years and has even shown stronger performance when inflation is above 3% and during periods of monetary tightening, which is why Forbes reports that an art collection has the potential to rival the long-term returns of bonds. So when I heard about today's sponsor, Masterworks, I knew I found a way to prepare for the impending hurricane. After acquiring the artwork, Masterworks then files it as a public offering with the SEC, allowing investors to invest in a portion of the painting. When thinking about new platforms, track record is one of the most important things I look at, and Masterworks is very strong. Since inception, Masterworks has sold 3 paintings, each returning over 30% net IRR to investors. That means if you invested $45,000, you get $60,000 back. Although past performance is no guarantee of future results, I think this concept is super innovative, and I'm not alone. Over 450,000 people have signed up to date, and there is a wait list to get started. However, by partnering with Masterworks, you can skip the wait by clicking the link in my description to start diversifying and preparing in just a few clicks. Now back to our video. We start with the obvious. The S&P 500, as I'm recording, is down around 21% from its peak in December of 2021. That makes this downtrend the 14th worst in US history. That may not sound as bad as it should be, but let me remind you that today's drawdown is unprecedented due to a number of evolving factors. I don't have to remind you that this is one of the first market crashes where the federal funds rate was close to zero when the trouble began. You see, normally in the past 40 to 50 years, the solution to market trouble was easy. Have the Fed reduce interest rates, which in turn would jumpstart the economy, acting as essentially a shot of adrenaline for the markets. The Fed has always acted as the pharmacist whose drugs push the economy past its slump and back into overdrive. However, after years of abusing the drug of money printing and 0% interest, the side effects are finally showing up. You likely have noticed the high inflation occurring around you. By the Fed's own measures, we are at 8.6% inflation, and if we use the 1980 methodology, we would be at nearly 17%. This creates a massive problem that is plaguing the markets. You see, the Fed can obviously choose to do what it has done before to save the market, which is to cut interest back to zero and introduce a bunch of money printing programs, but this is no longer a viable option because it would further increase the already high inflation, potentially putting us on a path towards the worst case scenario, hyperinflation. This double-edged sword is now in the mind of every investor and institution. All the companies and various bubbles funded by this easy money of the past decade are coming to an end. Zombie companies are businesses that earn just enough money to continue operating and service debt, but are unable to pay off the debt, are on the rise. Even bankruptcies are popping up. The makeup giant Revlon recently lost 95% of its stock value after it was announced it was filing for bankruptcy. Looking over its most recent earnings report, it's easy to see why. The cost to service its debts exceeded the money it brought in by a wide margin, and the future looks even worse for them unless the business can miraculously turn around. In plain English, Revlon doesn't have enough money to pay off the interest part of its loans, let alone the principal. And if these rate hikes continue alongside with this downturn, we can expect more and more cases just like this. You can see this downturn evolving throughout the market. As you may already know, companies provide guidance or predictions about the near-term expectations for a business. This happens during earnings calls, which occur 4 times a year. You know it's bad out there when a company does an earnings call, and before the next one can even happen, they issue revisions to warn investors of changing conditions. Target recently revised earnings, suggesting a 60% decrease in business expectations just weeks after their Q1 report. Goldman did something similar, and the CEO of Chase, the largest bank in America, outright told the public to brace for impact as an economic hurricane was headed towards the US. There are tons of recession alarms going off, and this is all happening in an environment where prices continue to rise. The root of all power and the king of commodities, oil, is where you'll find the most obvious evidence for this. Crude is nearly double what it was last year, and this commodity has way more impact than just gasoline prices. Oil is used in plastics, clothing materials, and food production. Realistically, it's at the base of our economy. With gasoline, jet fuel, and diesel essentially transporting the bulk of everything we make and move, a doubling in the price of this super commodity is extremely bearish historically. Looking back at the data, every time there has been a 100% rise in the price of oil within 1 year, what followed is a recession. It was true in 1990, it was true in 2000, and it was true in 2008. Last time prices got as high as $146 a barrel before it all came crashing down, and right now we're close to surpassing this all-time high. On top of this, what many people consider the #1 recession indicator has already sounded its alarm back in April. The 10-2 yield spread has an unbelievable record in predicting bad times. Almost every time this chart has gone below that zero line, what followed is a recession. Back on April 1st, it dipped below zero for about 36 hours, and it wasn't long after that we had a negative GDP print and a plummeting market. 10-2 is back to plummeting, and it looks like we may soon invert once again. A shocking development that provides further evidence that we're entering a recession. But let's go back to the beginning. Remember, I said many people believe that this will be far worse than just a recession. This could be a complete meltdown like 1929. But before we head down that path, we need to understand a bit of history. 1929 cannot be compared to anything else that has happened in the markets for the past 100 years. While there have been plenty of recessions, massive drawdowns, panics, and corrections, there has never been an event that caused the Dow to lose 90% of its value. Had you invested during the peak, it would have taken you 25 years to get your money back. That's how damaged the markets were back then. Imagine a crash in 1997 that the country just today recovered from. That was 1929. It changed finance forever and lived in the minds of the American population for decades to come. What set it apart from other meltdowns is that the government did not step in and help, or couldn't in the first place. By 1933, nearly half of American banks had failed and unemployment was approaching 15 million people, or 30% of the workforce. In fact, the country wouldn't really recover from this economic knockout until World War II, where an epic buildup and a strong win on all fronts catapulted the US into a superpower. So let's lay out the facts here. What we have is a government unable to help bail out the economy this time around, an economy fueled by speculation, easy money, and credit. This massive super bubble seems to be popping, and with no support in sight and a massive economic catastrophe up ahead, how does the government fix this? History gives us a couple clues, and the stage has been set. Thank you guys for watching. As always, please make sure you hit that like and subscribe button.
Okay, so really good to see you there, Gunny.
Nice.
You got a new background there, like we didn't know that this Eagle, Globe, and Anchor was part of the theme, but that's a really good one. I love it. Looks good.
Yeah, I like it too.
Yeah, of course. So really, I wanted to show this video just to kind of give everybody a perspective. MHFIN is just one channel that I use. Wealthion is another one. I watched some of the content.
What is it again?
Wealthion, well, it's like wealth and then ION at the end. Adam Taggart is the guy that's the host there. Really good content, and it's not really, I don't think it's as prejudiced. Everybody has a little bit of bias, but prejudice is when someone, is just blindly to their perspective and doesn't, it fails to ignore everything else. So we got a lot of things going on this week. We've seen a 75 basis point jump by the Fed. It was a higher hike than we expected. The markets responded the following day with some big losses. I think they tried to rebound a little bit yesterday. But what we're really seeing and what we focus on is helping individuals get out of debt, and how do they use their idle equity sitting in their mortgage. So I've helped a lot of clients lately that I think have finally woken up, because they were feeling the pinch of inflation, and they're like, wow, ouch, my credit cards, my other debt, along with this high cost of living increases, cost of fuel jumping above, $6, now $7. I was down in California last week and saw, $7 plus gas prices.
Yeah.
Crazy, we're going to see a lot of other ripple effects. We're seeing the trucking industry, from transportation, not having enough people to drive the trucks that are moving the products. We're seeing all of the kind of food shortages that are going to come about more often. And for some reason, baby formula. Why that? I don't really know. I've been too busy with other things to drill down and figure out. But the answer is we're seeing the first effects. This is not the end. This is the beginning. How long is it going to happen? No one has a crystal ball. What you can do to prepare yourself is to access that that idle equity that's sitting in your home. Why? Because when home prices finally adjust down and they reset, and you see home prices, possibly the average value falling 30%, 40% even, then the idle equity that you're not taking advantage is going to disappear. What you can do with it right now, before it disappears, is to gain that equity loan. And by using the equity loan right now, I just completed one last week. I was actually working with a doctor, and he was looking at doing something 6 months ago before Christmas, and I could get him 3.75% for 80% of his home value minus his mortgage. And now we are, 6 months down the road. The best rate I can get him is 75 basis points higher, 4.5%. But I can no longer get that rate at 80% of the equity. I can only get 70 now. Why? Because, well, lending institutions are smart. They're looking at what's happening in the marketplace, so they're not lending as high. So now I can't get you the maximum use of your equity. And when that house value starts plummeting, which they will, simply because the market is oversaturated with new bills, that are coming online. There's a lot of builders that have the highest negative sentiment by the National Home Builders Association that has happened in years, especially in the last 2 years. So they're all overbuilt, they're all overextended. And all of a sudden now we have too few of buyers, because now that mortgage rates have more than doubled, that means fewer people are qualifying for the same homes that they could have bought just 6 months ago, because your actual debt to income ratios are dramatically different. The calculations have all changed. So now we have a lot of people, too many people actually putting their house on the market at the same time, where we have more new bills that are coming online this summer than ever before in the history of the US, that were trying to take advantage of this big housing boom, not looking at the fact that this was the highest acceleration of home values ever in the history of our world. And no one was sitting there going, wait a second, eventually this dance is going to stop. And when we're playing musical chairs, there's going to be a lot of people without chairs. And that's what we're starting to see. Builders walking away from entire home building projects. We're seeing new home buyers that are walking away from the closing table, because where they were going to buy 6 months ago, now they're waiting for their home to get built. Now they're going back to the mortgage company and going, I can't afford that monthly mortgage rate. Or the mortgage company is telling them, your income does not afford that mortgage rate. We're no longer lending to you. So there's a lot of catastrophe that's happening. I think it's going to look bigger than the 2008. That's why I had you watch this particular video, because I like this channel. They actually show a lot of statistics. I apologize for the advertisement during the middle of the channel. That's getting a little bit aggravating, because this particular guy loves using this Masterworks art program, and he pumps it a lot. But of that 8 minutes, I think it was almost 3 minutes of him pumping his art, which I don't like. So I hadn't had a chance to watch that. I would have just kind of left that out. His statistics, though, are good. He does this good, well-researched content. So what do you do right now? I'm not telling you to go invest in art. I don't even know if that's a good, I've seen the recommendation. I don't know if that's a good option. What I am telling you is to get out of debt. The best rate of return, the best return on your money, is the guaranteed riskless rate of return that you can use to pay debt. So if you can get your 10 or 12 or 15 or 25% interest rate chopped down to 4.5% or 4.75 or maybe even 5%, it makes mathematical sense. Why would you not do that? I can help you with that. And then what do? Well, then we show you how to use paycheck parking and how to actually take your income and accelerate the payoff of that lower interest consolidation. Then what do? Well, when we pay that off, then we're going to take all that excess money. And if we're not having to use it to pay for increased cost of living, we're going to start using it to pay down that mortgage. But here's the bottom line. If you don't use this strategy right now, and mortgages, your equity in your home value decreases, and 6 months from now, you're going to be sitting here going, Steve, why didn't I do that? When I had 30% of my home value that I could have got in an equity loan and paid off all my debt, and I didn't do it because I'm too busy watching Netflix or too busy not making the right decision, watching all this tsunami coming right at my face, and I don't make a decision to make a smart transition, consolidate, and then get rid of my debt. Then what's going to happen? Well, 6 months from now, you're not going to have any equity in your home. And the debt that you have right now, that's 10 or 12 or 15 or 25, is going to crush you, because your cost of living is going to be so high. Cost of gas, you're going to pay for food and gas because you have to have it to survive. And what's going to be sacrificed? That high interest debt. What's going to happen to your credit? It's going to tank. What's going to happen down the road when all this is over? Well, you're going to be in a tough situation. So this is kind of like, I guess you would call it kind of the last call. If you're going to do something and do something smart, you need to do something now and not sit on your hands and think about it and do what you've been doing for the last 6 months or a year going, I wonder if Steve's right. No, I am right. And I'm not because I'm brilliant. It's because I listen to brilliant people, and I bring those brilliant people to you. So that's where we're at. Gunny, I know you've been in situations like this before when you saw bad scenarios coming in over the horizon, and you guys responded with extraordinary levels of what you would call devil dog, Teufelhoon, response because you guys were trained, you were ready. So you were, when craziness came over the horizon, you were able to respond with a level of focus and what would you call it? Measured, what would you call it? Measured ferocity. How about that? And
Okay.
measured philosophy. I like that. That's what devil dogs do. So, and that's why, you know, that particular fighting force that you guys have been around since before the U.S. If I'm right, it's November 1775 that the Marine Corps was incorporated in, is it Philadelphia? Is that my memory?
Yes, Philadelphia. Ton Tavern, Philadelphia, Pennsylvania, 1775, November 10th.
November 10th. Okay. I knew it was November 10th. So, and the reason why the reputation of the Marine Corps has continued to be that feared fighting force that no one wants to go up against is because of they prepare and they plan and they practice before the engagement. And so that's what this is right now. This is your planning, your preparation, your practice. But now, guess what? This is not before the engagement. The enemy is here. Inflation is here. If you don't do something now and you don't do something smart, then you're just going to get run over. And I don't want to see that happen to you, to your family. So if you're watching this and you want to reach out, let me help you. We can do that. We got time. It's not going to be the best scenario that we could have done 6 months ago, but it's better than doing nothing. And in 6 months from now, you're going to thank me. And in 2 years from now, I'll be on your permanent Christmas card list because it will be the difference between you actually surviving what's coming at us and you getting chewed up by it. So that's it. Gunny, you got anything else?
You might be get contacted by a guy. I think his first name is Wilbert.
Okay.
Like he likes to be called Jay because I guess he doesn't like the name Wilbert. I don't know his last name. He's in my computer classes.
Okay.
And I kind of in conversation. Everybody's pretty much a veteran in the classes, and there's not that many people. I think there's only 5 people that are still surviving.
Sure.
Yeah, because each time we've transitioned from one class to the next, we've lost 1 or 2 people. So we're down to about 5.
Okay.
And I kind of pitched it out there, and I left it open, and he's the only one that came back, which surprised me because he's a little secretive. Like he doesn't, he won't tell you his last name, or at least not us there at the class.
Okay.
And I don't know what branch he's in because he won't talk about that, but I know he did about 26 years in the military.
Okay.
And he's wherever he's at too right now, he's GS 11. So he's not doing bad for himself.
Sure.
And he's taking these computer classes because I think it has something to do with work related. He wants to move on to another position that kind of requires that knowledge. But anyway, yesterday he came back to me and he's like, yeah, can you send me that link you were talking about? And I was like, sure. So I sent it to him. And see if he reaches out.
Okay. I'll be looking for him. I'll let you know if he reaches out, and we'll go from there. So other than that, let's see you guys batten down the hatches because it's not just coming, it's here. So
yeah, unfortunately, but it happens.
It is. It's just going to be a test of seeing who's prepared and who's been sitting around on their hands and not preparing. Yeah. So
how's everything on your end?
All good, sir. All good. All good.
So what's the new position? You said you were down in LA and